My name's Robert Gardner and I'm Nationwide's Chief Economist. Well, overall, the economy's performance has been pretty mediocre. The economy grew by about 1.2% over the year as a whole, and what we saw was the economy gradually losing momentum over the course of the year. Brexit uncertainty continued to act as a drag on business investment, and weak global growth acted both to dampen investment but also to drag on export performance as well. Recent data has been quite mixed, quite hard to interpret, partly because of noise generated by the general election. What we saw was the economy growth grind into a halt at the back end of last year, but employment actually remained relatively robust. The economy added about 200,000 jobs in the 3 months to November, which is pretty solid. But forward-looking indicators suggest the economy did gather some momentum into the new year, and maybe that's what we'd expect given that there's now a more certain way ahead in terms of Brexit. We still don't know what the ultimate trading relationships will be, but at least we know what the process is going to be, and a more stable domestic political backdrop is also likely to give an economy a little bit of a boost. Nevertheless, what seems most likely in our view is that a lot of the factors that have been acting as a weighing anchor in the economy over the last 12 months are likely to persist through 2020 as well. It's going to take a while before the future trading relationships become clear, and until they do, investment's going to remain fairly weak. And similarly, global growth is also going to take time to gather momentum, so export performance will probably remain fairly sluggish as a result of that as well. So overall, the economy likely to expand by around about 1% next year, but then hopefully as we go through 2021 and beyond, as the UK's future trading relationships become clear and as the global economy gathers momentum, we expect the economy to gradually gather momentum, so growth may be picking up to 1.5% to 2% in the years ahead. But again, it's going to take time because it's going to be a while for the UK to adjust to those new trading relationships even when they become clear. Well, interest rate expectations certainly waxed and waned over the course of January. If you look at financial market pricing, in early January there was only a 5% chance attached to a rate cut at the end of January. That moved to over 60% by the middle of the month, and then just ahead of the January MPC meeting it was down to 50%. So why did things move so much? Well, partly in response to the ebb and flow of economic data as it suggested weakness and then strength, but also in response to policymakers' comments, as 2 of the 9 MPC members suggested they might be more minded to vote for rate cuts in the months ahead and join the 2 that had already voted for rate cuts at the back end of last year. So where do we go from here? Well, a lot is clearly going to depend on how the broader economy performs. If the uncertainty continues to lift in the quarters ahead and households and businesses become more confident about where the economy is heading and that a trade deal will be reached with the EU and other economies around the world, then hopefully that means the economy will regain some momentum and interest rates then would be likely to remain on hold through this year and next year. However, it's possible that the things that have been weighing down activity in terms of Brexit uncertainty and weak global growth, those factors again resurface and result in weakness in investment and trade, and that may mean that the MPC need to give the economy more stimulus to keep things going until those trade deals hopefully get reached at the back end of next year. In early February, financial markets suggested around about a 50% probability of a rate cut around August, and again that I think that's about right. It is very finely judged. A lot is going to depend on how the economy performs. And important to say that the MPC is adopting a fairly cautious stance, and it's right to do so because interest rates are fairly close to zero and the risks that face the MPC are asymmetric at this point. If they make a mistake and they cut rates and they shouldn't have, that mistake is fairly easy to correct because it can always increase interest rates in the quarters ahead and sort of get the economy back on track. However, if they make a mistake in the other direction and they don't cut rates when they should have done, that would be far harder to recover that situation because there isn't that much stimulus they can provide with rates already close to zero. So as we look ahead, there is a lot of uncertainty, but I think the MPC is going to be very sensitive to any negative news and be ready to provide that stimulus if it proves necessary. Housing market activity has been pretty stable over the last 12 months. In fact, if you look at mortgage approvals for house purchase, they've been running about 65,000 a month. Now, to be fair, over the last 3 years or so, they've averaged that sort of level. In terms of the pattern of transactions in the housing market, what we've seen is continued softness in terms of home mover activity, which is something that's been evident really since the end of the financial crisis. Buy-to-let purchase activity has also remained fairly soft, partly as those changes to tax and lending standards are continuing to exert a bit of a drag on the market. The area that we've continued to see growth, though, has been in terms of first-time buyer numbers, and that's supported by the strong labour market and continued solid growth in earnings. Overall, what we've had in the housing market has been sort of two forces operating to almost cancel each other out. We've got very strong labour market conditions and healthy earnings growth and low borrowing costs on the one hand, but on the other there is this still uncertainty about the broader economy and where we're heading next, and that's sort of acting as a drag on overall activity. In terms of looking ahead, what we expect to happen next, again, probably a continuation of what we've seen over the last 12 months, because we do expect the economy to remain fairly subdued over the next 12 months. The labour market remaining pretty strong, but still this uncertainty about where the economy heads next. But then as we look ahead, we look into 2021 and beyond, we expect the economy to pick up and the housing market's likely to pick up in line with that broader economic recovery. In terms of house prices, house price growth did pick up a little bit at the start of the year. We've seen at a national level house price growth rising to 1.9% in January. That's the second month in a row where house price growth has been above 1% after 12 consecutive months where it was below 1%. Nevertheless, 1.9% is still fairly modest, and as we look ahead over the year, we expect probably single-digit growth for 2020 as a whole, as the economy remains fairly subdued and that uncertainty sort of hangs out over the broader market. But then as we look into 2021 and beyond, we expect a little bit of a pickup in line with broader economic trends, but then we're still looking at probably low single-digit increases in the years ahead even then. If we look at regional trends, the patterns that we've seen in the last couple of quarters are again just a continuation of what's been happening over the last few years. The weakness really concentrated in London and the southeast of England, where we've seen small single-digit house price declines, whereas in most parts of the UK, what we continue to see is very small single-digit increases of sort of 0 to 3%.